Hey everyone, thanks for tuning in again. You're watching Invest a Voice. I'm Michael if you haven't met me yet. I've been in the financial world for about 2 decades now. I started out as the new kid, just a stack of business cards and a bunch of dreams. Over the years, somehow, I made it to the list of the best advisors in the country. Want to know the biggest thing I learned? It's not about being some genius, or getting lucky breaks, or even snagging the best advice. Honestly, the real challenge is way simpler. It's believing you actually can get there. Most people just never do. And I see this all the time. Folks look at millionaires and billionaires and think they're a different species, like they live in another universe. There's this mental wall. I'm not like that, they think, or people like me don't get rich. That idea trips more people up than any bad investment ever could. I mean, I've sat across from thousands of clients over the years, and you can just see it on their faces. The second I talk long-term strategy, it's the same routine. Yeah, but it never stops. Funny enough that yeah, but usually comes down to something as tiny as $5. Just $5. It's almost nothing. That's a fancy coffee you won't remember next week. Or maybe it's just the fee for your food delivery when you could have walked over and grabbed it yourself. Sometimes it's a few clicks in a phone game, gone in 10 minutes. We barely notice $5 slipping away. It's pocket change. But here's the twist. That pocket change is the most powerful lever you have for building wealth. I've shown the spreadsheets. I've run the numbers in front of whole rooms of people. Picture this. If you took $5 a day, every day, and dropped it in a simple, cheap index fund tracking the U.S. economy, and you earned about 10% a year, which, by the way, is a bit less than what the S&P 500's averaged. After 45 years, you'd have just under $1.6 million. Yes, really, almost $1.5 million, all from tiny, forgettable amounts. And whenever I show that number, the same 3 questions pop up without fail. First, Michael, I want to actually enjoy my money today. I'm not giving up my lattes or takeout just to maybe be a millionaire when I'm old. Not an uncommon response. Second, why wait until I'm old to be rich? I want it now. And third, the practical one. Are you telling me you can find something that gives 10% returns every year for almost half a century? I started hearing these again and again, even from smart people who really know their stuff. Eventually I realized you can't just talk people into believing. Spreadsheets don't change minds. People want to see something that actually works in real life. So I figured, why not put my own money where my mouth is and prove it? That's how I landed on this idea. My name's Michael. This is Investor Voice. And instead of just talking about it, I jumped in and did it myself. I set off on a year-long experiment, investing $5 every day, no matter what. Didn't matter if the market was up or down, if I was feeling excited or bored, rain or shine. Every single day for an entire year. Let's look at those comments again. The things that trip people up. First, I want to enjoy my money now. I get it. In my 20s, saving for one day felt like a punchline. I wanted the car and nights out. Waiting until retirement sounded miserable. But after 45 years watching people, I can tell you, those who chase quick enjoyment almost always wind up stuck in jobs they hate at 65. They don't see the difference between momentary thrill and real freedom. The key is this: no latte now compares to waking up years later and saying, I work because I want to, not because I have to. That freedom, not the fleeting thrill, is the real win. The second comment, I want it now, is really just impatience dressed up as some sort of philosophy. Everyone wants everything instantly: the movie, the delivery, the results. But the stock market, it has zero interest in your schedule. It runs on decades, not days. If you're trying to rush it, forget it. It's like planting seeds and expecting fruit by tomorrow afternoon. You end up disappointed, frustrated, or you accidentally ruin your own progress. Third, show me the investment. Honestly, that's the most reasonable of the bunch. There's no magical investment out there, no secret 10% guarantee. Here's what you really need: a slice of the whole economy. Buy an index fund that tracks the S&P 500. Over the past 100 years, it's averaged about 10% a year and survived all kinds of disasters: wars, recessions, pandemics, crashes, you name it. It's not a crystal ball, but it's honestly the most reliable engine for building wealth anybody's found. So, here's how I tackled this. I wanted to actually build the machine, so I started picking the right investment platform. Took me 20 years and a lot of trial and error, but now I've got my must-haves. You should too, if you ever try this. These rules aren't negotiable. First, fees. They're sneaky and eat at your money without you noticing. If you're investing $5 a day, but your platform charges you $1 each time, you've lost 20% before you even get started. So you need zero commissions plus low expense ratios. No argument. Second, the interface. It's got to be simple. I can handle a Bloomberg terminal and all that complicated stuff, but for this challenge, I wanted to make sure anyone could do it. If the app looks like a spaceship dashboard, charts everywhere, mysterious buttons, normal people will just close it and walk away. Clean and easy wins. Third, security. Your money has to be protected. In the UK, the Financial Services Compensation Scheme covers £85,000 if the platform fails. In the US, you've got SIPC. It won't protect you from the market's ups and downs, but it does keep your cash safe if the platform itself blows up. You need that backup. Fourth, low deposit requirements. This is about $5 a day. If a platform won't let you open an account for less than $500 or $1,000, forget it. You want one that's cool with small amounts and lets you start right away. And fifth, this is absolutely huge. You need automation. No way am I remembering to invest $5 every single day for a year. Life gets busy, you forget, or you talk yourself out of it. You need a platform that handles it automatically. That way you stay out of your own way and let the machine do its thing. Fractional shares have really flipped the script. Let's be real. One share of Amazon or Google costs a small fortune. Trying to save up with $5 a day, you'd be waiting forever. But now, you can grab just a slice, $5 worth, right off the bat. That means anyone can invest in big companies, even with a tiny budget. There are a bunch of platforms that offer this. Personally, I went with Trading 212 because I've been using it for years and trust it. So once I had my platform picked, opening the account was next on the list. And I'll admit, this step trips up a lot of investors, even seasoned ones. People usually open a basic account and don't think twice about the tax stuff. That can get expensive. Let me break it down as simply as possible. Imagine two boxes, A and B. You toss $1,000 in each. On the outside, they look identical. Inside, it's a whole different story. Box A is your typical investment account. Seems straightforward. You put money in, buy some stocks, and hope they grow. Then the tax man shows up. He takes a cut from your dividends. The cash companies pay you just for having their stock. How much he grabs depends on your income, but it's not pocket change. Sell your stock for a profit, and he wants more, usually 10 to 20%. Over time, those taxes shave off tens, maybe hundreds of thousands. Money you could have kept. Box B is where things get interesting. It's a tax-advantaged account. In the UK, it's a stocks and shares ISA. In the US, it's a Roth IRA. Here, the taxman doesn't touch your dividends or capital gains. Every penny you make stays yours to reinvest. It's like playing on easy mode. After 20 years investing, I can say this for sure. Always max out your tax-advantaged accounts before using a standard one. For this challenge, I wanted to keep everything, so I picked the stocks and shares ISA. Now, I didn't want to mess up my own portfolio, so I got my son Curtis involved. He agreed to be my test subject and opened a fresh account so I could show you the whole process from scratch. It's honestly simple. Download the app and you'll see a few options. General account, which we skip. CFD account for wild, risky trading. No thanks. Cash ISA for saving, not investing. And finally, the stocks and shares ISA. That's the winner. Just click, fund the account. I put in £35 from Curtis's account, about $45. 35 covers £5 a day for the week. And yeah, I know the challenge originally called for $5, but since I'm in the UK, I went with pounds. Same principle, slightly higher amount. Accounts open, money's in. Most people think the job's done. I'm invested, my cash is growing. Not so fast. This is where people get it wrong. The account's just the container. It keeps your money safe from taxes, but it doesn't make it grow. You still have to choose what to invest in. That's step 3. And honestly, this part spooks people the most. Folks think they need to be a stock market expert, studying balance sheets and financial reports for hours. But that's just not true. For this challenge, I chose the simplest strategy: index fund investing. Boring, but it works. Instead of guessing which company will skyrocket, an index fund owns tiny chunks of hundreds of companies at once. Instant diversification. I chose an S&P 500 fund, the top 500 American companies: Apple, Microsoft, Amazon, Google, Tesla, Nvidia, Berkshire Hathaway. One fund. I own a slice of every one. If Apple has a lousy year, there are 499 others holding the fort. Risk shrinks wide. The numbers back this up. Nobody has ever lost money with the S&P 500 by sticking with it for 20 years. No one. The past isn't guaranteed. Still, that stat speaks volumes about American economic resilience. Getting started on trading 212 was easy. They use pies, showing your investment split. I picked the Vanguard S&P 500 ETF. 2 types, AC and DIST. AC means accumulation. Dividends automatically buy more shares. Snowball effect. DIST pays cash immediately. I wanted snowball, so accumulation. Dropped in my pie, done in 5 minutes. Now here's where most people trip up. The actual investing part. Doing it every day, sticking with it. If I had to log in and manually invest £5 each morning, I'd quit. I know myself. So would most people. Life gets busy. You get distracted. You start making excuses, especially when the market's ugly. I'll wait till it recovers, you think, and then you never do it. That's why auto investing matters most. It's the secret weapon that keeps you on track. Auto investing does 2 big things. First, it takes your feelings right out of the picture. Your brain doesn't get a vote. No nervous second guessing, no greedy moves, no slacking off. The app just handles it. Second, you start dollar cost averaging, which means you put in the same amount, like clockwork, whether stocks are up or down. Some days you snag more shares for cheap, some days fewer. But in the end, you stop trying to time the market and let patience do its work. That's how people actually build wealth. I just opened my pie in the app, hit auto invest, and set £5 a day, every day, for a year. The app gave me a little forecast chart, said my £1,800 could turn into about £1,970 after a year. Cool, but I know reality doesn't always follow fancy graphs. Named my pie Coffee a Day, hit confirm. Now it's on autopilot. I don't have to think about it anymore. My money's working while I live my life. For this challenge, I picked dead simple. Index fund investing. Instead of chasing unicorn stocks, rare high-growth companies, I can own stakes in hundreds of companies with a single click through an index fund. This means instant diversification, since my money is spread across many industries and sectors. I went with the S&P 500 fund, America's biggest companies, Apple, Microsoft, Amazon, Google, Tesla, Nvidia. If Apple tanks, I still have 499 others. Tesla stumbles, portfolio barely notices. That's spreading risk. Over the past 20 years, no one has lost money in the S&P 500. Nobody. Track record says something. Getting started on trading 212 was ridiculously easy. You create a pie to decide your split. To keep things simple, I stuck to the Vanguard S&P 500 ETF. You get two choices, ACCC and DIST. ACC means accumulation, where dividends automatically buy more shares. Think snowball effect and compounding. In contrast, DIST pays cash immediately. For long-term growth, accumulation makes sense, so I dropped it in my pie. It was done in 5 minutes. Account, check. Investment, check. Now comes the hard part, actually sticking with it. If I had to log in daily and invest manually, I'd likely give up in 2 weeks. Life gets busy, and I'd start skipping days, especially when the market drops. The temptation to wait for it to go back up would take over, and I'd never invest again. That's just how people are wired. This is where auto-investing totally saves the day. It's basically a life hack. First, it takes emotions out of it. You don't have to think or second-guess yourself. The app just does its thing. Your nervous or distracted brain can't get in the way. Plus, your dollar cost averaging without even trying. The market's always bouncing around, up, down, all over. But if you just put in the same amount every day, you buy more shares when the price is low and fewer when it's high. You stop overthinking about perfect timing and actually end up ahead. Spending time in the market really beats out trying to time every move. So I set up Auto Invest on the app, £5 a day, every day for a year. The app even shows a little estimate. According to that, my £1,800 could turn into around $1,970 after a year. It's nice to look at, but honestly, I'm not sweating the exact number. I called my pie coffee a day, hit confirm, and that was it. The machine took over. Now I can just forget about it and get on with life. After a whole year messing around here on Investor Voice, what's the lesson? It's simpler than people think. You don't need a ton of cash or a finance degree. You don't need to sit up late reading stock charts or wait for someone's secret tip at work. All you really need is a bit of cash, a clear plan, a tax-advantaged account, a low-fee index fund, and the discipline to set up auto-investing, and then just let it roll. That's the recipe. No tricks or shortcuts. That $5 you normally drop on a coffee or a snack, that's your seed. Instead of spending it, toss it into a tax-advantaged account, keep feeding it, and give it time. That's how things grow. It's not about missing out on fun now. It's about making a choice for who you'll be later. You're giving your future self options. Freedom at 65, peace of mind, maybe even the ability to help your kids and grandkids out. That's real power, just deciding to take the wheel. And honestly, I'm tempted to let this experiment keep running. Just let Auto Invest do its thing for 5 years, 10, maybe 20. I want to see that little seed turn into a tree. I want to see how big compounding can get over the long haul. I want to show you, if you stick with this simple plan, it actually works. If you're curious to see what happens next, 2 years in, 3, even 5, let me know. Really, just drop a comment. It's your feedback that keeps this channel alive and lets me know what matters to you. Do you want me to keep this experiment going? Tell me. And if you're ready to take charge of your money, if you want more real-life experiments, straight-up talk, and proof you can actually use, hit subscribe. Join Investor Voice. We're growing all the time, and I want you here with us. If this helped you today, tap that like button. It helps more people find the channel and lets me know I'm actually making a difference. Share this video with someone who needs to hear it, maybe a friend, family member, or anyone who thinks investing's out of reach, because honestly, it isn't. I'm Michael. Just remember, the road to $1 million starts with a small step, or even just $5. The real question isn't if you can invest $5 a day. It's if you can afford not to. Catch you next time.